Good morning, and welcome to Leavitt's webinar on health insurance marketplace exchange notices, and it will also be on IRS penalty notices. My name is Lisa Klinger. I'm one of the attorneys at the Leavitt Group and GBS, and today's date is September 8th, 2016. If you want a copy of the slides for this webinar, they are posted, and you can download them. It's at our website, which is healthreformupdates.com, or also news.leavitt.com/healthcare reform. Or you can just follow along here. But the slides, it is again HEALTHREFORMUPDATES.com. So it's healthreformupdates.com or news.leavitt.com/healthcare reform. And if you have a question, you're in listen-only mode, but you can type the question in the box on your screen, and I will try to check it every so often. Or you can also just wait till the end and ask questions, and I will stay on and answer questions at the end. The webinar is being recorded, so it will be available later if you want to hear it, or if others do who aren't here. And it's just a half-hour webinar today. We're going through it pretty quickly, just the one short topic. We do offer free webinars every so often for clients and prospects. We try to offer them once a week, and the next webinar will be October 20th from 10 to 11 a.m. and it will be on audits, IRS and DOL and HIPAA audits, what to expect, especially with the Affordable Care Act. So we will get started on this. Let's see if that works. There we go. The agenda, I'm going to cover a lot in half an hour. The two different types of government notices, the exchange or marketplace notice, and then also the IRS notice. I'll explain a little on the background on applicable large employers, or ALEs, and the employer shared responsibility and potential penalty. Then I'll focus on the marketplace subsidy notices, what they are, how to appeal them if you want, and what are the bases for appeals, and then what you need to remember. So, the two possible notices, the first that we're talking about today mostly are the marketplace subsidy notices. And that is sent by the health insurance marketplace or the exchange. It notifies employers, any size employer, not just applicable large employers, but it notifies any size employer if at least one of their employees qualified for a subsidy and bought health insurance in the marketplace in the current year. So if you get a notice in 2016, it's about what's happened so far since January 2016. And the two types of subsidy that someone could qualify for are the advanced premium tax credit, often called the APTC, or a cost-sharing reduction. And you probably already remember that people can qualify for a subsidy if they meet other requirements, but the financial one is that their household income is 100 to 400% of the federal poverty level. And if they're in a state that enacted the Medicaid expansion, then the Medicaid eligibility is up to 138% of the federal poverty level. So that's why an employer might get one of these marketplace subsidy notices. The other type of notice is the IRS penalty notice, and these have not been issued yet. They wouldn't be issued until later this year, probably after the election. And this notice, the IRS will be assessing an employer shared responsibility penalty on an applicable large employer who did not offer minimum essential coverage, MEC, in the prior year to at least 95% of full-time employees, or who did not offer affordable minimum value coverage in the prior year to a particular full-time employee who then went and got a subsidy to buy insurance in the exchange. Now actually so it's looking at the prior year. Actually for the notices that you might get in 2016 that relate back to 2017, the requirement was only to offer minimum essential coverage to at least 70% of full-time employees. But starting in 2016 and going forward, the requirement is 95%. And no penalty would apply unless at least one full-time employee, not just a part-time employee, but a full-time employee, bought coverage in the marketplace and qualified for a subsidy. Also, the initial notice that the IRS sends, although we're calling it a penalty notice, it's just notifying the employer that it appears that they owe a penalty, and then there will be time to respond or appeal that, and then the IRS would respond before a penalty would actually be assessed. So it's just a notice of intent to assess a penalty. It's not the actual notice and demand for the money. And just to review a little on the IRS notice, it should only be received by applicable large employers who it appears have not met the employer mandate or employer shared responsibility, as it's technically called. And so this tries to show in a simple way what those rules would be, that the applicable large employer must offer minimum essential coverage to full-time employees, and in order to avoid both the penalties, it has to be both affordable and provide at least minimum value. Or the ALE may have to pay a penalty called the employer shared responsibility penalty if any full-time employee gets a subsidy to buy insurance in the marketplace. And just a reminder, I'm sure you all know, a coverage is affordable if it's not, for 2016, more than 9.66% of the employee's household income. That is, if the employee cost for employee-only coverage is not more than 9.66%, and it could be household income, or it can be one of three safe harbors, since employers won't know their employee's household income. So the three safe harbors are either the W-2, Box 1 amount, or the rate of pay amount, or the federal poverty level. And then minimum value means that the plan pays at least 60% of plan expenses on average, and the employee pays not more than 40%. So a little more on the penalties and subsidies. If an employee enrolls in minimum essential coverage, but that coverage is less than minimum value, or it costs more than affordable coverage, generally the employee would not qualify for a subsidy. However, if the employer pays 100% for that minimum essential coverage that doesn't provide minimum value, then the employer does need to allow the employee to disenroll from the MEC coverage, the less than minimum value coverage, in order to be eligible for a subsidy. Because if the employer offers MEC coverage that doesn't provide minimum value, that protects the employer from the first penalty, A penalty, listed below, but it doesn't protect the employer from the B penalty. So if the employee enrolls in and stays enrolled in the coverage, then that employer would not have a penalty. But if the employee doesn't want to be in the employer coverage and instead wants to enroll for a subsidy in the marketplace, then they can do that. The employer can't prevent an employee for getting a subsidy if the employee is otherwise eligible for the subsidy. And the two different types of penalties, as I mentioned before, there's an A and a B penalty, and they're under Internal Revenue Code Section 4980HA and HB. And the A penalty is if the employer offers minimum essential coverage to less than 95% of full-time employees. And as I mentioned, for 2015, it was less than 70%. And that was initially the $2,000 annual penalty, or $150 a month. That's indexed for inflation, so now for 2016, that amount is $2,160 a year or $180 a month. The B penalty applies if an employer does offer minimum essential coverage, but for a particular full-time employee, the coverage is either not offered, maybe they're in the 5% that weren't offered coverage, or the coverage is not affordable or doesn't meet minimum value. And then if the employee goes to the exchange and gets a subsidy, the penalty for the employer is, it was originally the $3,000 a year penalty. Now it's $3,240 a year or $270 a month. But the B penalty has a cap. It can't be more than what the A penalty would be if the employer didn't offer coverage. So it's capped at the number of full-time employees for the month minus 30 times $180, because that's the A penalty monthly amount. So if you had a lot of employees for whom coverage was offered but it wasn't affordable, and they went to the exchange and bought coverage and got a subsidy, that penalty would be $270 a month for each full-time employee, but it can't be more than what it would be if it were $180 a month times the total number of full-time employees minus 30. The other thing I want to note about the IRS notice is that these notices will be generated automatically based on the 1094 and 1095 A, B, and C's that are filed, and based on the employee 1040s that are filed. So there's no audit lottery. You don't want to just say, well, I'll just see if I get caught. I won't offer it and I'll see if I get caught. It's going to be based on when the computer reconciles the 1094 and 5 A, B's, and C's, and then it'll just send out the notice. So since that notice also depends on the employees having filed their federal income taxes, 1040s, that won't be, that date with extensions is October 15th, and so it wouldn't be until at least after October 15th. Personally, I suspect they'll wait until after the election, since that's November 8th, and I think they won't be sent out until then, but we'll see. So since the IRS notices will not be sent out till later, I'm focusing on the market subsidy notices today, the marketplace subsidy notices. So first, and how to appeal these and whether to appeal them. First is the basics: who, what, when, where, why. So who sends it? The federal marketplace will send it, and also state marketplaces can send it. The state marketplaces can have their own variations of the model federal marketplace notice, and all state marketplaces could send a notice. So far, 8 of them have agreed to use the federal. There's also a federal form for the employer appeals if they want to do that. So 8 of them have agreed to use that so far, California being one of them. California, Colorado, the District of Columbia, Kentucky, Maryland, Massachusetts, New York, and Vermont. So if you're in those states, even if you get a notice of, say, from Covered California, and I have a screenshot of their notice coming up, you can use the general federal employer appeal form if you want to. The why, the reason for the notices, as I mentioned before, is to notify an employer that one of their employees has qualified for a subsidy and bought coverage in the marketplace. And it could be a full-time or a part-time employee. The notice could go to a large or a small employer. So it might be that there's no potential penalty for the employer. It's just a notice that this person who said they're your employee qualified for a subsidy and bought coverage in the marketplace. Also, when, as I mentioned, the notices are being sent now, and they are regarding coverage and the subsidy in the current year, as opposed to the IRS notices that are talking about what the coverage offered in the prior year. These are being sent under the Affordable Care Act, ACA Section 1411, so they're sometimes called 1411 notices. And it's the exchange verification process. So the marketplace or exchange is verifying that this individual is eligible for a subsidy. And the other verification they do automatically or electronically by accessing IRS records to look at the household income, and by accessing immigration records to make sure that they're a citizen or lawful resident, but there's no way to electronically access whether the person was eligible for affordable minimum value employer coverage. So that's why they send the subsidy notice to the employers and to get a response from the employer. And so what there's a notice to the employers, there's an employer appeal form, and there's also an employer coverage tool. And I have screenshots of those, and I'll explain what they are. So here's the subsidy notice to the employer. This is the HHS letter. And of course it would be customized, and it goes on for several pages, but it just says it's to the employer, and it says the person listed below submitted an application for health coverage in the health insurance marketplace in Virginia or whatever, and indicated that he or she is your employee, and they reported that they didn't have coverage or offered, or it wasn't affordable, and then it will just list the person and their birth date. It can also list the last 4 digits of their social and the marketplace application ID. And then it explains to you, the employer, why you're getting this notice. Now, this is the covered California subsidy notice. So it's based on that federal notice I just showed you, but as I said, a state exchange does not have to use the federal one. So theirs is a little different, and also I don't have the next page of theirs, but they don't list the Social Security number. They just list the employee and their birth date. So they don't list the marketplace application ID or the last 4 of the Social Security number. And so this is letting the employer know. And then a little bit more on the marketplace notices. So for the exchanges did not send notices in 2015, but in 2016 they're sending them not to all employers for all employees, but for employees who enroll and get a subsidy and who provide a name and address of their employer when they apply. The marketplaces are required to send a notice. So in what you as the employer might want to do, 2 hot tips for you. When you hire a new employee, you're required to give them a notice of marketplace coverage within 14 days. You could also, we recommend that you also give them that notice when they terminate. So, and because that's when they may go to get marketplace coverage. So in that notice, be sure you put the address that you want to be used, or that you would want any notices to come to from the exchange or marketplace. Because if you have multiple locations, it's likely that an employee who is terminated and goes to the exchange will know the address of the location where they worked, but they would not necessarily know or remember or think about the address of your headquarters where you might want the notices sent. So especially if you have numerous locations, or if you have a large single site, you might want to notify your mailroom so they'll be on the lookout for, if you're in California, it'd be a notice from Covered California, or otherwise it would be the notice from the federal exchange and that sample that I showed. And so be sure to notify them so that they'll forward any of those that they get to your corporate HR or benefits department. So if you do get the appeal notice, and the subsidy notice, and you want to appeal it, what should you do? Well, first of all, you're not required to appeal it, but you can. If it applies, if you feel that the person should not have qualified for a subsidy, it may help you to appeal the notice, because at least in theory, the marketplace should notify the IRS if you appeal and you're successful, and that may prevent you from getting a IRS notice next year. But if you appeal it for 2006, that won't have any effect on the IRS notices that you might get this year, because the IRS notices for this year relate back to the 2015 year and the offer of coverage in 2015. And then if you do want to appeal, you have to appeal it within 90 days of the date you receive the notice. If you don't appeal it, there's no penalty on you for not appealing it. So it's not like there's a penalty if you don't appeal it within 90 days. But if it's more than 90 days, the marketplace just may ignore your appeal. And the other thing to remember is the appeal to the marketplace is not about whether the employer owes a penalty. The IRS decides that, and both the letters say that. But the appeal is basically telling you an employee qualified for a subsidy. I mean, the notice is telling you the employee qualified for a subsidy. So if you appeal it, you're saying, oh, wait, this employee shouldn't be eligible for a subsidy because they work for me and I offered coverage that's both affordable and it provides at least minimum value. Also, if an employee is enrolled in coverage, what the rules say is if an employee enrolls in coverage that's not affordable or doesn't provide minimum value, but they enroll anyway, then they should not be eligible for a subsidy. So you still probably want to notify them if it's that. Except I'll talk about kind of one exception. Let me see, there is a question. I've received an HHS marketplace notice for an employee who was terminated 12/8/15. The notice states it's for 2016. Do I appeal it by indicating the terminated date of the employee? Oh, good question. So, actually, I'm just addressing that in this slide. This is should you appeal if. So, these are, if an employee, let me go through some of these. If an employee works part-time, so they weren't eligible for the employer group health plan, you don't need to appeal that, or you wouldn't really appeal that to the marketplace. Because the marketplace is saying, is this person eligible? So the answer really is yes, they are eligible if they work part-time, so they're not eligible for your group health plan. So you don't need to appeal that. And then the next one, what if an employee was in their waiting period or in a measurement period to determine if they're full-time? Well, you would not appeal that because if they're in a waiting period or a measurement period, then they're not eligible for your employer group health coverage. So they are eligible for a subsidy or to buy coverage in the exchange and for a subsidy if they qualify. Let me skip down to this other no and then I'll come back to that one. If the employee did not work for you during the months to which the notice applies. So for example, the question that someone just asked, if the employee terminated 12/8/15 and the notice is for 2016. So probably what happened is the employee, when they applied, they just put down their most recent employer, even though that's probably not what it asked for. It asked, are you currently employed? So you really don't need to appeal that because, like in this case where the employee terminated December of 2015, if that employee has coverage and a subsidy from the marketplace in 2016, then they are eligible for that subsidy because they no longer work for you. So just because you get the notice from the marketplace does not necessarily mean that you will owe an IRS penalty. So if the issue is employee eligibility, then you want to appeal it to the marketplace. But if the issue is whether the employer would owe money, then you want to appeal that to the IRS. So the next one is, what if the employee is enrolled in employer coverage that's not affordable or does not provide minimum value? Well, if they enrolled in it and they have to pay for it, then I would say, yes, you do want to appeal it, and say that they're enrolled in your coverage. But if you, the employer, offer coverage and you pay 100% of it, and it doesn't provide minimum value, then you probably can't really appeal it because what the employee is eligible to enroll in coverage, and the IRS has issued guidance that basically says an employer can't prevent employees from getting a subsidy if they qualify for one. So if you're paying 100% for minimum essential coverage that's less than minimum value, you need to, if somebody goes to the exchange to get a subsidy, you need to allow them to unenroll from your coverage. The next one is if you're a small employer and you offered this particular employee coverage that was affordable and provided minimum value. Well, you can appeal. Technically, the employee is not eligible for coverage because for marketplace coverage or a subsidy. But there's no employer shared responsibility penalty on you. So, and you're not required to complete the appeal. So if you're busy with other things and you don't want to do it, there's no effect on you. But if you are an applicable large employer and you offer this employee coverage that was affordable and provided minimum value, then you do want to appeal it because, as I said, at least in theory, the marketplace should notify the IRS that that this person should not have been eligible. And the marketplace will review your appeal and decide within 90 days, they'll tell you what their decision is and they'll let the employee know. There is another question, how can we get a copy of the slides? The slides are at healthreformupdates.com and also that's at news.leavitt.com/healthcare reform. And it's listed as the first article and there's a link to the slides there. So this is a screenshot of the employer appeal form. And this is the federal form that the federal marketplaces are using and also 8 of the state marketplaces. And maybe more of them will end up using it as well. I don't know why they wouldn't, frankly. So section 2, I just want to point out, you can designate a secondary contact. It's optional, you don't have to, but this is someone else that if someone else is going to help you with the appeal. So, for example, that might be your Leavitt broker, or maybe it's an outside law firm. Also on section 3, you tell why you think the employee should not have been eligible for the subsidy. So again, you wouldn't be saying why you're not subject to a penalty. You would just be saying why the employee should not have been eligible for a subsidy. And it might be that you're saying it was affordable. So you include documentation showing the employee shared cost for the lowest cost self-only coverage was less than $93 in 2015, or less than 9.56% of the employee's compensation using the W-2 or the rate of pay safe harbor, or 9.66% in 2016. And then the other thing, it might be that you're showing documentation showing that the coverage was minimum value coverage. So it might be on the SBC where it says it was minimum value. And this is a screenshot of section 3, and then section 4 you sign. So it's a very short appeal form, and you can attach additional pages if you need to add additional information. And then the other things, more on the employer notice of appeal, you can either use that appeal request form or you can write a letter and include all the information in the letter, the employer information, and they also ask that for both of them you attach a copy of the notice that you got. You can appeal it online or by fax, and through the end of 2016 you can also send it by snail mail. You can do a paper appeal. And the address for the appeals is Health Insurance Marketplace, HHS, London, Kentucky, and here's the fax number. So even if it's from Covered California, for example, you're appealing it, it looks like, to the marketplace, federal marketplace address, and only include the minimum necessary information in the appeal. Like for HIPAA, you want to be sure you're not including any individually identifiable protected health information. I don't think that you would be, but just keep that in mind. And also you don't need to include any additional information like why you shouldn't be eligible, why you shouldn't have a penalty, when the issue is only why the individual is not eligible for the subsidy. And then the marketplace will respond within 90 days of your appeal. And they will also, I added this slide since I posted the other ones earlier yesterday, but then I was going to just talk about this and I decided it's enough information I'd add a specific slide on it. So you appeal, the marketplace responds to you within 90 days to let you know they're looking at it and what their response is. The marketplace will also notify the employee that you have appealed. So you may want to have a letter that you send to employees letting them know that you appealed it. And then if the marketplace finds in your favor and says, well, yes, you did offer minimum value affordable coverage to the employee, then you that means they also give the employee the right to appeal their decision on your appeal. So what if an employee gets the subsidy but really did not qualify for it? So you the ramifications for the individual is that they'll have to repay the tax credit, but that would be after the end of the year. And also, there are limits on how much individuals have to repay. And the lower their household income is, the lower the amount is that they have to repay of the premiums. So if you do appeal it and someone loses their coverage, they probably will not appreciate it because it probably means that they won't have health insurance coverage this year. Whereas if you didn't appeal it, even if they weren't eligible, they would have the health insurance coverage, and then next year, after probably October, it would all get reconciled with the 1094 and 1095 A, B, and C's, and they may have to pay some of it back, or they may be required to pay it back. But it's actually a small percentage that they may have to pay back, because if the household income is less than 200% of the federal poverty level, the amount they would have to repay for individual coverage is only $300 for the year, and the family coverage is $600. And then at 200 to 300%, it's increased, and at 300% but less than 400%, so that's the household income as a percentage of federal poverty level. For individual coverage, the maximum they would have to pay is $1,250, and for family coverage, it's $2,500 for the year. These amounts have been indexed for inflation, so it's a bit more than that now. But if you have a low-paid employee, and if they don't qualify for your coverage, or if the employee coverage actually is affordable, but they go to the exchange and get the subsidy is likely to be $800 or $1,000 a month. So they could be getting a subsidy of $12,000 for the year, and if their household income is less than 400% of the federal poverty level, the most they'll have to repay is $2,500. So it can have significant ramifications for the employee. Now here are some of the resources I've talked about. Here are the links to the resources. And I should have listed where I posted the PowerPoint also. The PowerPoint is at the website is healthreformupdates.com or news.leavitt.com. So news.leavitt.com and then /healthcare reform. Even if you just go to news.leavitt, that you should be able to get it there, or healthcarereforms.com. Actually, I take that back. It's healthcarereform.com. So the employer appeal request form and instructions and the employer coverage tool. Then there are also here we go, several health prior articles, recent and older articles on healthreformupdates.com. And there's also the Marketplace Appeals Center. That's for the employer. If you're appealing and you have questions, you can call that number. And I have just a screenshot of the instructions for the Federal Employer Appeal Form. And the instructions and the two-page appeal form themselves are really all the same document, but this is the cover page with the instructions where it lists the 8 states. Then the employer coverage tool is a tool that either the employer or employee can use. So for example, the employee could fill out their information, the employee name and social security number, and then give it to the employer to find out what coverage is offered. Or you, the employer, could complete it and give it to employees who either don't enroll but who are eligible or will be eligible, or you could give it to new hires who are in their waiting period or who are in a measurement period. And this just says, for example, is the employee currently eligible for coverage, or if not, will they be eligible in the next 3 months? And it's just a 2-page form. So then it says, do you offer coverage that for the employee's spouse or dependents? Does the plan meet minimum value? Is it affordable for the employee? And then if the employer is going to make changes for the new plan year, if that's coming up, what will the change be? When is it effective? And what's the change in price or whatever? So that's it. The things you need to remember. The exchange notice, again, is on the employee eligibility for subsidy. So it's not on whether the employer owes a penalty. So whether the employer owes a penalty is what you may need to appeal later in the IRS notice, or you could get a notice from the marketplace, but possibly not end up getting a notice from the IRS later because of the information that's in the 1094 and 1095 A, B, and C. For example, the employee who terminated in December and wasn't your employee in 2016 for the IRS notice for 2016 probably would not address that employee. And another thing to remember, you're not required to appeal, even if you can. If you do want to appeal, the time frame is 90 days after you get the appeal notice, and the subsidy notice. If you do appeal it, you may want to send a letter to the employees, the affected employees as well, because the marketplace will do that. Again, your appeal for 2016, if you appeal to the marketplace, that won't affect whether you get the IRS notice in 2016, because that 2016 IRS notice relates back to 2015. Also, just a reminder, it is illegal to discriminate against an employee because he or she received subsidized coverage in the marketplace. And the subsidy notice that you get from Covered California or from HHS it states that in the letter. And if you do want to appeal and you want help, then your Leavitt advisor can help you with that. So that's it. We did it in just a little over 30 minutes. I see I have one other question that's more specific, but I will, if anyone wants to stay on, I'll go over that. Again, if you want a copy of the slides, healthreformupdates.com. Let me actually go back to this. Another one. Here's where some of the resources are, and healthreformupdates.com is where the articles are, and then I posted the slides there just yesterday. The other question that's come in, our payroll company received the Covered California notice, which they then forwarded to us. We offered this employee coverage as of 7/1/16, but he declined. The notice is addressed to our workers' comp payroll company. Do we appeal, and who is required to respond, as we are not listed on the letter? That's an excellent question. I was talking with some people about that at the PIRA meeting, or PIRA conference last week, and the I think that probably you want to appeal if you offered the person coverage and they declined, if you offered minimum value affordable coverage and they declined. Let me just see, on the appeal form, let me go back to that. You probably need to put the payroll company's name on it, since they're the ones who are listed here. But the thing you might do is, in part 3 of this, where it explains why they're not, in this part is where I think you might want to put your employer name as well as the payroll company. And I'm just looking, yes, because it wants their business name, primary business address, and their federal EIN. You may also want to put, so I guess the two things, on this, and I think that's going to be a common situation, that it's going to go to the payroll company, especially if they're listed on the paycheck and the employee takes the paycheck with them. I think in Section 2 is where you may want to designate the employer as the secondary contact. And you may want to send it back in if the payroll company isn't sending it back in. But I think if it was sent to them, if they're listed as the employer, you might need to put the payroll company or name in Section 1 and put the employer's name in Section 2. And then you could also note, especially in Section 3, that you're actually the employer, if you're the common law employer, but the notice went to the payroll company, so you would appreciate it if any future notices would be sent to you, or sent to you as well as the payroll company. And I think that's it on those are the only questions. So thank you very much for attending. And again, we have another free webinar on October 20th. So if you'd like to attend that, if you are a Leavitt client or prospect, you'll probably get a notice from the same person who sent you this invitation. And if you got the invitation at the PIRA meeting, then please contact me or someone at Leavitt if you want to get an invitation to our future webinars, and I'm sure we'll put you on the list. Okay, thank you very much, everyone.